Okay, guys, so I'm going to get started here. Thanks to everyone who's joining us, and we're just going to let people kind of filter in. And so today we've got, on today's webinar, I've got Chuck Spitzer. Chuck is the president of Captive Insurance Group, which is the group that I use in my captive insurance company. And I think it's a great option for a lot of you, especially those of you who are small business owners. And so hopefully you'll get a lot out of this. So what we'll do is we'll have Chuck do a presentation for about 30 minutes, and then we'll take questions at the end. So Chuck, thanks for joining us.
Glad to be here. Thank you for inviting me.
So yeah, you can. I'll let you just kind of take it over from here.
Okay, sure, absolutely. Glad to do it. Appreciate everyone's time. What I'd like to do is just kind of walk you through what a captive insurance company is all about. Probably some of you have heard about them previously. They're often spoken about because of the potential for tax advantages in them. Those certainly do exist, but at their core, they are an insurance company. And so I will walk you through what that looks like in terms of it actually being an insurance company, because in order to obtain any kind of tax benefit,
Oh shit. Chuck, I can't hear you anymore, so I'm trying to figure out what's going on. Hold on, everybody. I don't know what's going on, so I'm going to call him. Okay, can you say something real quick?
yes, can you hear me?
Yeah, sorry about that. Okay.
Okay, no worries. So I wonder if everyone else can hear as well.
Yeah. Can everyone please, once again, make a note?
Okay, here are notes saying yes, they can hear. So good, I think we're back in business.
Okay.
Okay, I'll proceed. So I'll kind of start back at the beginning. So often captive insurance companies are spoken about because of potential tax advantages of them, and certainly those do exist. But at their core, this is about whether or not it makes sense to create a privately owned insurance company to insure some of the risks that you have in your business operations. So that's part of what I'm going to walk you through, and I'll also walk you through what the potential tax advantages are as well, so you can see both. But really, these small captive insurance companies are another tool for people to use as a risk mitigation and risk management tool in their business. It's about the formation of a licensed insurance company insuring real risks in business operations. So we know that most businesses currently carry different kinds of commercial coverage. So depending upon the kind of business you're in, and obviously this is just a very generic slide, but we want to know how you're currently insured, meaning do you have inventory? Are you a professional service organization where you have maybe professional liability? Do you have directors and officers coverage? Are you insuring your content? How are you currently being insured from a commercial insurance carrier? So we analyze that on the front end and want to know that. And part of the reason why is that we want to see where there might be gaps in your current insurance coverage that might make sense to be insured in a captive insurance program. So, we're talking about gaps in coverage, exclusions from coverage, or even risks that you really can't effectively go by in the commercial insurance market. Here is just a snapshot of what some of those things might look like. Things like the risk of the loss of a key person, a key employee, business litigation coverage, deductibles that you have on your commercial coverage. You'll see here a couple of examples where we put policies in that are designated as DIC. That means difference in conditions. For example, many business owners will have business interruption coverage in their business owner's policy that you're buying from a commercial carrier. You may have mechanical breakdown coverage, but we will put in place a DIC or difference in conditions policy to pick up areas where there are typically exclusions from certain kinds of coverage. Business interruption is one of those. Often mechanical breakdown is one of those. Oftentimes we'll see clients that have employment practices liability coverage. We'll put a DIC policy in there as well, because often the commercial coverage doesn't fully cover what circumstances can be when there is an event of a claim. So in point of fact, we have more than 40 lines of coverage that are possible to put into a captive insurance scenario. And if we have a client that comes along that has a very specialized need, we can always analyze that and determine whether or not it makes sense to put it into a captive program. But you can see that we go through a very formal underwriting process to look at what the risks are in the business and what might make sense to actually go into a captive insurance program. So kind of the steps that we go through are delineated on this slide. So we go through an initial analysis of just figuring out, does it make sense for someone to consider a captive insurance program? And in so doing, we will gather up financial information. We will gather up the current insurance coverage that's being purchased from a commercial insurance carrier. We'll also want to understand what the corporate organizational structure looks like, meaning what are the entities that are in the mix? How are they owned? What kind of entities are they for tax purposes? Because it definitely is a case where first of all, a captive insurance program is not for everyone. In our particular circumstance, we kind of set a benchmark of a client having a budget of about $400,000 for insurance premium in order to enter into a captive program. That's not a hard and fast rule. We do make exceptions from time to time, but the point is it's not for everyone, and the client really needs to be of a size where it makes sense from a risk perspective that they have sufficient risk to price a premium that's meaningful. So we gather up all of that information that I just described, meaning financial information, current insurance coverage, corporate organizational chart with entities, how they're owned, what they do. And then we do that analysis without a charge to you. We do that on our own nickel and then come back to you with a picture, if you will, of what we believe this looks like in your situation. Meaning, here are where we think there are risks. Here's what we think potential lines of coverage would be in your situation. And here is our best educated estimate of where we think premiums would fall in your captive insurance program. And then we come back and present that to you together with a 10-year pro forma that details out how the math works in one of these situations. The next step, if our client likes that whole process and wants to go to the next step, the next step is to engage an independent actuarial firm who does a study of the feasibility of implementing a captive insurance program. And in that process, the client, you would actually pay to have the actuarial study done. But before that, we're going to walk you through all of the details, make sure you know how the math works. But when we get to the actuarial stage, then there is a charge. The charge is $5,000. We don't mark it up a penny. That is what the actuaries charge our firm to have that work done. And so the deliverable back then from that process is what you would expect to receive from an actuary. And no, Dr. Joffrey has, he's seen his own actuarial study, and it's going to be 70, 80, 90 pages long with lots of statistical documentation on how premiums were determined, all of the Monte Carlo simulations that are done by the actuaries in order to determine those premiums, all of the assumptions that are made in the determination of those premiums. But there's one page in that report that tells us here are the various lines of coverage that make sense to go into this client's captive insurance program. And here is the premium for each one of those lines of coverage, all priced separately. So that's kind of the process that we go through. What makes the sizzle on these smaller insurance companies work is this election under Section 831B. Now, 831B is a code section that has to be done exactly right. I'll tell you, we are very, very conservative in the way that we go about that, because if it's not done right, the IRS can be and will be very critical of an 831B election. So this slide kind of paints the picture of what that looks like mechanically. So we have the operating business here, and that operating business, and there may be 10 operating businesses that are insured by the captive program, all of which who may pay their proportionate share of the premium that is determined. But let's assume there's one operating business. It pays premium over to the insurance company. It takes a tax deduction for that premium. When it goes to the insurance company, where we have made an election under Section 831B, the insurance company does not pay tax on that premium until there is a distribution out of the insurance company. So let me say that again. So the operating business is going to pay premium to the insurance company. The operating business is going to take a tax deduction for that premium that's being paid. Virtually every one of our clients are at top marginal tax brackets. So, it's a valuable deduction, assuming that, they're going to qualify for the insurance. When it goes to the insurance company does not pay tax on that premium until the money's distributed out. Now, let me focus on the insurance company just for a moment. This insurance company is a C corporation for tax purposes. Every insurance company in the United States is a C corp. So premium gets paid and money begins to accumulate in this insurance company. That money can be invested. It has to be invested in accordance with an investment policy statement that is approved by the Department of Insurance, but nonetheless, it can be invested. Typically, that's going to be a fairly conservative kind of an allocation model, meaning stocks and bonds and treasuries and that sort of thing. The insurance company does pay tax on its investment income. It pays tax at C corporation rates, but doesn't pay tax on the premium until it's distributed out of the insurance company. So let's see what that looks like. There's two main ways that money comes out of the insurance company. First of all, when money gets distributed, it more often than not is distributed in the form of a dividend. Because this is a U.S. C corporation for tax purposes, that distributed money is a qualified dividend. So thus, it's getting taxed at a 20% tax rate currently under the Tax Act of 2012, plus in 2016 and so far in 2017, it had the 3.8% surtax associated with it. So it's getting taxed at a 23.8% rate. So back over here, as I said, virtually all of our clients are paying tax in their operating business, whether it's taxed as a C Corp or if it's a flow through, a pass through entity, 40+% is very typical. So you can see that part of what drives the economics of these small insurance companies is this arbitrage that exists between the marginal tax rate and the qualified dividend rate. Another part of the strategy would be if someone implements a captive insurance company, maybe they have it in effect for a year or 10 years or 3 years or however long, but maybe they sell their business or they retire from their business, or maybe they just decide they do not want a captive insurance company any longer. Then we would liquidate that insurance company. We would do a liquidating distribution of the assets of that C corporation, and it would be taxed as a long-term capital gain. Under current tax law, that's the same rate as what you see on this chart for a qualified dividend. And it also is a matter of you can't pay premium, this Wednesday and next Friday decide you want to take money out of the insurance company. The money has to season in the insurance company. These are real insurance policies. And this insurance company earns its premium over a year's period of time. So we typically tell our clients, you shouldn't plan to take any money out of the insurance company for at least 18 months. And why 18 months? Well, it probably can be a few months shy of that, but the money has to become fully earned by the insurance company. We like for it to go through one financial statement audit cycle, and we also like for it to go through at least 1 year's regulatory reporting cycle before we distribute money out. So that's one. Two, you have to realize that it is an insurance company. It can have claims that it pays. So you can't ever be absolutely certain as to the amounts that are going to be distributed. And before there can be a distribution in the form of a dividend, it requires regulatory approval. Now that's not a very harsh requirement. It's part of what we actually do as the manager at the insurance company. So the tax treatment of the insurance company I've already explained, but I'll also explain to you that these insurance companies have to comport to one of these 3 revenue rulings that were issued back in 2002. Almost all little insurance companies in the United States all depend on this one revenue ruling 2002-89. So let me give you what the Reader's Digest version of that is. It basically is that your insurance company has to participate in a reinsurance risk pooling arrangement with other insurance companies. The one that Dr. Joffrey is involved in, that he's already mentioned to you that we manage for him, has about 70 companies in it. They are all our clients. We manage all of the insurance companies that are in the reinsurance risk pool. But in effect, your insurance company would take on a little piece of the risk of other insurance companies that are in the risk pool, and they in turn would take some of your risk. So there are certainly limits to that, but it's an absolutely necessary part of forming one of these insurance companies so that it is in compliance with the IRS guidelines. There was a recent tax court case involving a captive insurance company, and one of the main reasons that court case failed, and it's one of the first ones that has failed, by the way, in tax court, was because their risk pooling arrangement did not comply with the safe harbor guidelines. So another example of why these really have to be done properly to make sure they stay in compliance. So who qualifies as a captive owner? A trader business that has ordinary taxable income and who has identifiable insurance risks that will warrant some fairly significant level of premium, and a business that has consistent cash flows. Now, that doesn't mean there can't be fluctuations in the cash flows of these businesses, because certainly there can be. And there can be adjustments made as it pertains to their captive insurance program. For example, if their budget changes with respect to their captive insurance premium that they can spend, we can make adjustments to adjust accordingly in the captive program. But it's important to realize that they have to have real, identifiable, insurable risks. And so we have had we've had a lot of, we're based in Texas. So in the past several years, there have been many, gas royalty owners who wanted to have a captive insurance program. But the fact is that if they were royalty owners, their greatest risk here was that they would trip on the way to the mailbox to get their check out. There's no real operating risk that they had. So, others where there's family offices and they have only investment income, those don't work. They have to be participating in real operating businesses that have risks that can be insured. And I always like to make this last point too. These insurance companies are regulated by the Department of Insurance. And so someone who is forming one of these and who owns one of these has to be willing to observe the formalities of owning an insurance company, because you do have to play by the rules. That's really where our firm comes in, is making sure that your captive insurance program is implemented properly, and then we manage all the ongoing regulatory and tax compliance aspects of the insurance company. So, for example, my background is that I'm a CPA. Others on our team are attorneys. We have other accounting types and tax types that are on our team. So we're very much technicians as it pertains to keeping these insurance companies in compliance. So what are the things to consider in this case? As I've already mentioned, there is a first-year actuarial fee of $5,000, and that's a first-year fee only. After that, we pay all of the ongoing actuarial costs out of the annual management fee that is paid to our firm. That annual management fee is based upon the amount of premium, to some degree, the amount of premium that goes into the insurance company. There are windows of fee levels based upon premiums that go into the insurance company, because under that election, under Section 831B, that little insurance company can accept premium of up to $2.2 million annually without paying tax on it until it's distributed out. So it's quite a big number, and so there are costs that are incremental in association with the amount of premium. So we have a sliding scale of what the management fee is. That is an all-inclusive kind of a fee, meaning that to the extent that there's ongoing actuarial costs, that gets paid. There's premium tax that has to be paid by these little insurance companies. That gets paid out of the annual management fee. There also has to be regulatory filings. These insurance companies have to have books and records maintained. They have to have a tax return prepared. All of those things are paid out of the management fee that we are paid. So kind of to give you some idea of what that looks like, the fee on an annual basis is on a sliding scale, the least of which is $27,500 a year, and the highest amount is $57,500 a year on all the premiums between $400,000 and $2.2 million. So, and our fee is capped once they reach $1 million in premium at $57,500. So that is an ongoing annual cost, but it covers all of the management costs of maintaining the insurance company. Also, I mentioned this risk pooling that most clients have to be involved in order to comply with the IRS guidelines. There's a cost associated with that. That cost is 2% of annual premium, because the risk pool isn't actually another insurance company, and it has to pay premium tax, it has to be audited, everything that every other insurance company has to have. So there's a cost of 2% of annual premium. That's all the cost. In addition, in our program, we do not charge an additional first-year fee for the analysis. I've already told you we do the initial analysis without charging. There's no implementation fee, meaning all of the documents that have to be prepared including the plan of operations, everything that has to be prepared in order to file with the Department of Insurance. We do not charge an additional fee for in the first year, or in any year. We do not charge that fee. So this does require the professional help, meaning that I've already told you that it requires the services of an independent actuarial firm. We insist that our clients talk to their own tax and legal professionals. Our firm is a management firm. Do we have CPA? Do we have lawyers? Yes, we do. But we are not a law firm. We are not an accounting firm. We're not a tax firm. We want our clients to rely on their own legal and tax advice. And we are happy to interact with them in that process. But we do expect for our clients to talk to their own professional advisors. Restricted implementation rules, meaning that there has to be real insurance risk. The lines of coverage that are put into a captive program are looked at by the Department of Insurance before the plan of operation is ever approved. And so there has to be a real business purpose that includes risk management and risk mitigation. Or said another way, it is not a valid business purpose to say we're paying too much income tax, so we want a captive insurance company. That's not a valid reason to have one. That does not meet the business purpose rules relative to establishment of a captive. There are also IRS reporting requirements. Anyone who owns a captive, is insured by a captive, or gets a benefit from a captive, that has to be disclosed to the IRS. Now, we facilitate that disclosure, but it is something that has to be done. So what is the process to see if this works for someone? I've already alluded to all of this in my earlier remarks, but basically we're going to gather up 2 years of information, whether it be tax returns, we prefer tax returns, or financial statements. So we want to see historically what's happened, and we want to see what's happening in the current year. We want to look at the current insurance coverage that's being purchased from a commercial carrier. We want to understand the organizational structure, meaning what are the entities and how are they owned. And then we come back, as I said, with this presentation of a pro forma economic model based upon an estimate of premiums so that our clients can see what it looks like before any money is spent. So the rest of this is pure propaganda. But that's the process. And that's what a captive insurance company is. And that's kind of how it works and why it works from an economic viewpoint. So Dr. Joffrey, I'd be happy to entertain any questions that people may have. I don't know how you want to go about doing that, but yeah, I'm more than willing if they want to, unmute when they want to ask a question. Happy to do it.
Yeah, I'm going to just have people type questions in. Sometimes it makes it a little bit easier. And so anyone out there wants to ask questions, go ahead. I'm going to ask a couple things I sort of know the answer to already, but I think are probably relevant. One is, you were talking about dividend distributions, but there's also a way to simply borrow money from your captive insurance company and thereby create, so you're not creating a taxable moment. Isn't that true?
Yeah, that is true. I will tell you this tax court case that I mentioned put a little different slant on that, and we're working through that right now, to be honest with you. Probably what we're going to see is a little more stringent guidelines on what loans can look like, meaning that they're going to look a whole lot more like bank financing than they did in the past. But the answer to your question is yes, that certainly is a possibility that a loan can be made by the captive insurance company. Yes, sir, that's correct.
When you talk about some of the potential restrictions, are you talking about more that, in the past, I mean, obviously you're lending out, you could have extremely low interest rates that you would not see at a bank. You're saying that you might actually have to have insurance or interest that would be comparable, but you could still do it. Is that kind of what you're saying?
Yeah, like for example, our attorneys are telling us that loans ought to bear some function of the prime rate whereas before it was pretty much best practices that they comport to AFR rates. So that's going to definitely be a change. You're going to see a slight bump in the interest rates that are coming through captive programs.
But that gets paid back to your own captive company, though, correct?
Yeah, exactly. That's right. Exactly right. You're paying yourself, your own insurance company, the interest. And the other thing that we're seeing is that one of the criticisms that came out of that court case that we're kind of digesting right now, but which I think the result's going to be to say that probably the term of the loans shouldn't look like a mortgage loan anymore.
Sure.
You know, the term of the loans is going to need to be shorter than they previously had been.
Yeah, yeah. Another question, and I don't know, this might have changed since I started my captive, but wasn't there also some potential advantages down the line as an estate planning vehicle?
There were, and that changed at the end of 2015 when the bill was approved that moved the maximum exemption or 831B from 1.2 million to 2.2 million that became effective January 1 of 2017. As a part of that same bill, there was a change in the way the estate planning aspects of a captive work, where frankly it just makes it a little more stringent over on the risk pooling side in order to meet the estate planning aspects of it. Honestly, what we learned from all of that is the IRS does not like the estate planning aspects when it's attached to a captive insurance program.
Right, but those who got it back then sort of got grandfathered in. Is that kind of?
Well, you didn't really get grandfathered in, but we just figured out a way to keep making it work, which we have done. But we're discouraging clients from doing it any longer.
Okay, and then yeah, I think that's it. Let's see. I'm looking. I don't see any questions out here yet. I know we have certainly a number of small business people. I don't know if they're necessarily on this, or physician.
Well, sure. Well, I understand, and the fact is that people are going to digest some of this, and then they're going to have questions.
Yeah.
So yeah. I would embrace the idea of you providing my contact information.
Yep.
And we are more than happy to entertain any questions that anyone has.
Yeah. Here is a question. Amir had a question right here. It says, "Is the minimum premium $400,000 for the year?"
That's what we're shooting for, Amir. The fact is that if we see that a client is in a growth pattern, we will take a look at where they are and where we think they're going to see if they're going to get to a $400,000 premium in a relatively quick period of time. So we're happy to talk about it and see where things stand currently to see if it makes any sense. But if someone just asked us, if we had somebody just coming to us and they didn't come through you, Dr. Joffrey, or your contacts, we would tell them $400,000. But we'll be certainly happy to look at each individual situation to see if it makes sense. That's really what we're about there is, does it make economic sense for you to consider doing it?
Another question I think that is people might be wondering is the money, the premium that you put into the account. They might be wondering, well, what's going on with that premium? Who invests it? How is it invested? Is it invested?
Yeah, good question. So what happens is that the insurance company, first of all, to take a little step backward, it is its own legal entity. It has its own articles of incorporation. It has its own bank account. It has its own employer ID number. It is a completely separate entity. So yes, it's going to have its own bank account. It's going to have its own investment account. And so as premium gets paid, it's going to go into the account of the insurance company. And that money that's in the account of the insurance company can be and should be invested. The investment should comport to an investment policy statement that we file at the time that we organize the insurance company for approval by the Department of Insurance. And as I think I said earlier, it's a fairly conservative allocation model because it's an insurance company. So you would expect that. But the fact is, the answer is yes. It has its own accounts. The money is invested. We do not do that. That's not what we do. We will work with your investment advisors. And I think, Dr. Joffrey, you have some ideas about how all that works, and you would be a good source to talk to about that. But we do not control the money that's in the account. You, as the owners of the insurance company, do.
Okay. I don't see a lot of questions here. I think this is something that, there's a lot of, and I don't know if they joined us necessarily today, but a lot of self-employed dentists and physicians and real estate folks who could really benefit from this. So I do encourage you guys to reach out. The easiest thing might be just so that you, just for familiarity, just shoot me an email, which is buck@wealthformula.com. And let me know if you want an introduction to Chuck and the rest of his family there, who do a great job with this stuff. And and I will forward it along. So again, Chuck, thank you, and Derek and the rest of the gang for your time.
No, thank you. Appreciate it very much. And I'll just reiterate that. Happy to answer any questions. Whether you do business with us or not, doesn't matter. We'll happy to answer any questions you have.
Will do. Thank you. Appreciate it.
Thank you very much. Okay, thanks to everyone.